Hi guys, hope you're all well. Just want to say, please like this video, please hit the subscribe button and you can get all the latest updates from us here at Flambard Williams. Without further ado, let's head to the video. Hi guys, so welcome to this month's edition of the Zoopla market report. Now we're here pretty much getting to the 6-month period and we're halfway through the year. No one knows where this year's gone, but it's flown by. And already we're seeing a pretty similar pattern in terms of the property market. There's some headwinds out there, things like obviously inflation, higher interest rates, cost of living crisis. So what we're doing is we're going to try and factor all of that in today, see how it impacts us, see how it's impacted us as landlords, because obviously that's our prime market. And yeah, let's go from there, and without further ado, let's dive into the report. So first of all, let's take a look at what the overview is. Now you can see here that we've got the current price, the house increase is 8.3%. Demand for homes over a 5-year average is up 58%. And we've got the flow of new supply it has increased 3%. Now I'm going to come to the supply side in a minute, because the supply side can be a little bit misleading in terms of the actual number that it's increasing by, but we'll come to that shortly. Now, as we continue down, you can see here there's continued high levels of buyer demand is putting upward pressure on the pricing, and as I said, that's increasing at 8.3% year over year. We've got here the average property price. Now, this is an amount that we never thought we'd be at a couple of years back. We thought it was going to take a longer time to get here, but 250,000 we're close to being the average price of a UK property. Now that's up over 10%, so up 29,000 since the start of the pandemic. So many people thought the pandemic was going to be a time to reset the property market. They certainly didn't think it was going to spur it on, but as we've seen, it's been absolutely fantastic. And that's really because even though we had the pandemic and even though we've had certain other attributes, the fundamentals still remain the same. And we always talk about the fundamentals here, whether that be taxation, legislation, interest rates or lack of liquidity. The fact that they remained the same during the pandemic, if not people had more money in their pockets due to certain furlough schemes and the lack of having to go to work, commuting and paying for lunches. People had more money in their pockets, hence why we've seen things rise, but the fundamentals did remain the same. But of course we are seeing those fundamentals change now with interest rates starting to increase, and we'll come on to that a bit later in the video. And as you can see here, in terms of areas, we've got Wales still 12.1% up over the last year compared to a 3.4% rise in London. Now that might not sound a lot in London, but I can assure you if you've got a decent property in London, let's take you've got a £1 million property in London, you've made a fair old whack on the price of your property. So the reality is it doesn't matter where you've got, pretty much you're going to make money in the last sort of 12 to 18 months. Now this is key as well. The new homes sale is rising up a modest 3%. I'm going to come to that first. Let's cover the supply and demand. The reality is if demand is increased and supply is restricted, it's the basic rule 101 of economics. The reality is if you've got tight supply and high demand, prices are going to go up. Doesn't matter what the product is. Now that has been the case. Now why has there been a tight supply? Well, there's been a tight supply of new homes because the cost of materials have gone up. That's the first thing. So people stopped building. The materials actually weren't available at certain points in time. So again, things have slowed down. And people were off site, so the construction industry dramatically slowed down right at the start of COVID in March 2020. So because of all of those things, we're now only starting to see things get back on track slightly, but the cost of materials hasn't decreased. So as I've always said, an actual developer will factor in 15 to 20% margin in terms of their profit margin. If they're not making that because the cost of materials have gone up, they're simply not going to build. They're simply going to wait, land bank, and then build another day. As simple as that. Or they'll wait for the house prices to increase, what they have done, and then they'll start to build then. Alternatively, what a lot of developers I've seen do is they've sold X amount of number of them. I've seen developers go back and ask for more money. They can't legally do that because they've signed a contract, but some developers have done that. That's typically developers who aren't that cash rich or they're not fully funded, so we obviously want to avoid those developers. Or we've seen developers sell one batch at a set price, and all the rest of the availability they've got and added 15-20% onto the prices. There's things like that that's happening in the market at the moment. Now as we come down to the supply, let's head right the way down this report, because sometimes these figures can be a little bit misleading. So you've got here the regional new supply hotspots. So you can see here Kensington and Chelsea. month-on-month growth of new supply, 53%. Now, whilst it might look like that they're building a huge amount of new properties there, depends what it started at. If they only built 2 properties last year and now there's 3 properties available, well, it's gone up 50 odd percent or 50%. But the reality is they're only building 1 more new property. So I think this chart here is a bit misleading. So I'm not going to spend too much time on this, because the reality is it's not how much it's gone up by, it's actually how many they started with at the time. Because you might have another borough which, for example, is building 5,000 new homes, but the reality is if they started at 100,000 at the time, well, it's only gone up 5%. Whereas it looks like Kensington and Chelsea are building a huge amount of new homes because it's gone up 53%, but we don't know the starting point. So for me, this is a bit of a misleading table. But look, let's head up to the top again, and we can start talking about the house price growth and where we are. Now, we obviously know that we're near a 15-year high. The house prices climbed, as you can see here, by £441 in March, nearly at that £250,000 mark, and it's at the highest levels over the last 3 months since 2007. So the average house price growth since the start of the pandemic, March 2020, is 13%. That's the average. There are some areas in Wales, Liverpool, Manchester, Leeds, Sheffield, which are well over that, coming close to 20% plus. So the reality is that if you found the niche, if you found the right pocket of development and right area, you'd have made an absolute fortune over the past 18, 20 months in the property market. Now, we're seeing is, as the stock market is taking a bit of a hammering in the US at the time of writing, and in the UK, more and more people are turning to bricks and mortar. So that's putting more pressure on demand, and of course the supply simply is still not there. So we still feel that there's still legs in this property market. And we're going to come on to the negatives in a minute in terms of the interest rate rises, but we still feel that the way things are, there's still a lot of room for improvement in the property market. As we come down, this is a great chart here, because what you can see is the annual house price growth. So let's have a look at the pink dot. So the annual house price growth here, where is it its highest? You can see on the left hand side it's Wales, South West, East Midlands, Northwest, etc. But you can see where the house prices start. So what we look at is, you can see obviously an area here, London. London has the lowest house price growth, but the highest price. So a combination of that just simply don't work for an investor. But as we start to look at the northeast, again, places like Newcastle, it's got a low entry point, but a decent growth level. And as we start to look at the northwest, places like your Manchester and your Liverpools, again, you're starting at a lower point than you are in London, but again, fantastic growth. So if we compare the northwest here to the southwest, well, you can see that they're pretty much on an even keel in terms of the average house price growth. However, your entry point is much lower in the northwest, therefore it makes a better investment. Why? Well, because you don't have to put down as much money, your stamp duty is going to be lower, you're going to be paying less interest on your mortgage, so all of those attributes mean that it's just going to make a better investment. And we've seen here, how has the pandemic impacted stamp duty? Well, because we have the stamp duty holiday and the prices jumped on the back of that as well, we're starting now to see that the property prices are going up brackets. So, those property prices that went from maybe 230 to 250 to 300 and so on, they're starting to cross over brackets, and hence why people are starting to pay more stamp duty. Now, the government love the property market boom, because the reality is it gets them a huge amount of receipts in stamp duty. So the amount of money they make from stamp duty, which is just another glorified tax, has been phenomenal for the last 18 months for them. And then you can start to see here the number of properties that have moved across stamp duty threshold. So you got the £250,000 threshold. Over 2 million properties have moved across that particular threshold. Now, as we start to come down, now this is key for us as investors. So we've got first-time buyers here need larger deposits and higher income. In terms of the average deposit that they need, now this is average. There are some places which will be less, and there's some places will be a lot more. But it's showing here that the average buyer must find an additional £4,000 here for a 15% deposit. So you've got £4,000 here for a 15% deposit, and an additional £5,000 in added income. So the reality is you've got someone who needed a £5,000 pay rise and they had to save an extra £4,000. Now that's unlikely. So what we have to look at is, what do? What do first time buyers do during times like this when there's a bit of uncertainty around the market, whether it's the property market, stock market, whatever it may be? Well, they rent for longer. It's a fact. And when we go back to previous years gone by, when there's uncertainty, whether it be uncertainty for COVID, uncertainty due to elections, uncertainty due to inflation rises, whatever it may be, they rent for longer. And when we look back at recessions, and we look back at recessions, whether that be the early 90s, whether that be 2008, 9, 10, and we look back at recession periods, again we see more renters than buyers. So then what we can actually show and demonstrate is it's fantastic a time for buy-to-let investors to buy, because we have a higher demand for rent. So what people do is they rent for longer, therefore it's even better time to get hold of property from an investment perspective. So again, because people wait, and because that rental demand is so high going across cities, especially city centres where the younger demographic want to be, and that's the best market to aim at for a rental perspective, because if you rent to families, then the wear and tear is actually much higher cost. If you rent to a younger demographic where they're out all the time, they pretty much sleep there, because the majority of the time they want to be city centres, close to bars, restaurants, work. The reality is you get a better type of tenant. The younger demographic will simply rent for longer, so there's still a great run to be had for investors. And then, of course, as I mentioned, the supply hotspots, which because we don't know where it started. Again, I don't feel that this is particularly relevant. And we can come down to the outlook, and it talks about the headwinds here. We know that there's higher interest rates. If you picked up a paper, you think it's doomsday, but the reality is we saw that during COVID. We saw at the start of COVID, the papers said that there was going to be a 30% fall in the property market. The Bank of England even said there was going to be a 30% fall. They were nowhere near it. It went up over 10%, as we've seen, or 13% on average, and in some areas 20% increase. So in those areas, they were 50% out of their prediction. It was ridiculous what they were predicting. And again, the same now. We're going to see a lot of the naysayers, but the reality is that where the interest rate is, we are actually not that high in terms of historical interest rates. We've seen interest rates in the 80s and 90s, 15, 16%. We're now at 1%. So we know that it's still a great time to lock in that mortgage. So if anyone's on the fence and they don't know what to do, with everything going the way it's going, you can lock in a 5-year mortgage. You're going to know your payments for the next 5 years. Rent's going up. Property prices are still increasing, albeit not as quick as they once were, but they're still increasing. And if you couple the rent, the fact that you're going to make 5%, 6% rent potentially, plus 3, 4, 5% growth, so you've still got a 10% investment there. And the beauty about the investment in the property market is if you've got your deposit and you're making 10% on your deposit in terms of income and growth, you've also got the money which is the bank's lent you. It's leveraged. It's something that you wouldn't have had anyway. You can't go into the stock market and say, well, here's 50,000 and I want to borrow the other 150, whereas you can in the property market. So you're making money on someone else's money, on the bank's money. You're making money on that as well. Now that's what is so great about the property market. So all in all, things are looking strong in my opinion still. And as I say, I still think we've got legs in this market. Yes, of course, if we start to hit interest rates of 3.5%, things are going to slow down and there'll be some bids on prices and we might see a bit of an ease back, but I don't think we're there yet. And the last page, as always, we can see the top 10 or the top 19, but in the top 10 we've got Liverpool, Nottingham, Manchester, Bournemouth, Leicester, Leeds, Portsmouth, Sheffield, Bristol and Cardiff. And the top 3 we're aiming at, Liverpool and Manchester, are our go-to cities. We know those cities inside out, we know the areas, we know that sometimes property isn't about just buying anything in the area, it's about finding the best value property in that area. And as I say, we've got the tools for that. So look, thanks again for tuning in. Hit that subscribe button. Make sure that you send this round to friends and family. As I say, if you subscribe, you'll get all the real-time information from us. And yeah, please like this video too. Take care. Bye-bye.